Good afternoon, everyone. Board of Directors of Emirates, thank you for having us here this morning. We are NPV Consulting Group. My name is Preston. These are my colleagues Patrick, Vince, and Sabina. Our vision for Emirates is a strategic partnership with Hainan Airlines, a market leader in China. This will pave our expansion into the intra-China and Asia-Pacific markets through a sub-branding effort. Over the course of our presentation, we'll be guiding you through our analysis, introducing you to our jetting ahead strategy, walking you through tangible implementation, and finally covering some key risks and mitigations associated with this proposal. The SWOT analysis framework served as a guiding tool in structuring our thought process surrounding this case, and we started from a lens of core competency. What has allowed Emirates to succeed in the past, and how can we scale that forward into the future? And what it really boiled down to was the Emirates standard. Emirates is a brand that has become synonymous with luxury. And while the mega hub model has served us well in the past by being a center hub for much of the world's air travel, that has precluded us from much of the Asia-Pacific market expansion, as it doesn't make much sense to fly through Dubai to get to America. And so we see an opportunity as far as the emerging markets go in the Asia-Pacific that will allow us to differentiate ourselves from fierce Gulf competition and congestion in that airspace and gain a competitive advantage. Now I'd like to pass it off to Patrick to talk a little bit more about our market analysis.
Thank you, Preston. So in looking at the emerging markets, we decided to focus specifically on the BRIC countries. These countries represent 40% of the world's population and are the fastest growing world economies right now. So of the four, we decided not to focus on India because Emirates already serves them very well. And of the remaining three, based on factors such as potential growth as well as air service demand, we see that China is outstanding and beats these other two countries in every way. We believe that this represents a great opportunity for us. Now let's look closer at China. And we find that China has a growing upper middle class, and they bring with them increasing disposable income as well as a greater increase for tourism. In fact, tourism has increased 50% in 2 years, and China is poised to overtake America as the biggest business travel hub in 2016. So we conducted a market gap analysis to find out where Emirates would fit in this strategy. And we find that Emirates actually goes far and beyond the quality of service of any other airline flying the Asia-Pacific route right now. We see that even though other airlines match the same size, they don't match the same quality. Now we want to build on that, and I'll let Sabina tell you how we're going to capitalize on this niche. Thank you.
Thank you, Patrick. China is our opportunity to jet ahead. This is why we believe that Emirates should establish a strategic partnership with Hainan Airlines. The first thing we considered was the Chinese government. China is a challenging regulatory environment. Without the government's support, we cannot move into the Chinese market with an impenetrable market. 55% of Hainan Airlines is owned by the Chinese government. This tells us that by establishing a partnership with Hainan Airlines, we are working with the government other than against it. Other than governmental support, Hainan Airlines gives us 3 advantages. With 6 regional hubs spreading across China, from Beijing to Tier 2 cities such as Dalian and Qingdao, we are servicing more than 57 million customers, giving them access to more than 537 destinations. In exchange, Emirates is bringing 3 benefits onto the table. First, we have younger and more advanced fleet. Second, the international prestige that's associated with our brand image. This helps Hainan Airlines move into the global market looking forward. And third, since much of our branding has been associated with sports, and China has a huge sports culture, we really do see the Chinese culture accepting our brand. This is the result, our sub-brand. We present to you the Hainan Emirates. This Hainan Emirates capitalizes 2 of the most dominating trends in China. First, their demand for international prestige and luxury items, and second, their strong national pride and their demand for national champions. Hainan Emirates builds in the international prestige and bolsters that national pride within China, carving out a very unique market niche that has never been tapped before, establishing Hainan Emirates as the premier airline in Asia and worldwide. Now Vincent will go into market penetration.
Thank you. Now, as we mentioned earlier, Hainan Airlines has 6 different hubs in China, the largest being Beijing. And the blue dot here represents the population of New York City. So we can really see the size of what we're dealing with here with Hainan Airlines. Now, amazingly, only Beijing is considered a Tier 1 city in China, and the other 5 hubs are Tier 2 cities, which means they are characterized by high growth, an expanding upper middle class, and less congestion than the Tier 1 cities in terms of airlines, in airports. So this is going to be a positive factor, and so we can reduce the congestion in the Dubai hub, as well as enter as a first mover in the Tier 2 cities. Now, of course, Hainan Airlines flies to over 500 different locations, and this will be the foundation for our intra-Asia expansion into the market. Besides China, we will be also looking at Southeast Asia, specifically Vietnam and Indonesia. But most importantly, we see Hainan Emirates, this sub-branding strategy, as being the foothold into the coveted Asia-Pacific market. And we do this through 3 specific route recommendations within the first 5 years, which are Beijing to Seattle, Los Angeles, and San Francisco. Now, Seattle and Washington State are major exporters to China. San Francisco is the favorite tourist destination of Chinese tourists, and Los Angeles has been the home of multi-billion-dollar construction projects from Chinese investors in recent years. These are the footholds that will give us the expansion into the Asia-Pacific markets, and moving into the future, we will incorporate Tier 2 cities that Hainan has as its hubs once we become comfortable with the Tier 1 Beijing routes. And this will really allow us to deepen our penetration into this market and move forward with that. Now I'll hand it off to Preston, who will look at the actual implementation process and the numbers behind our strategy.
Thank you, Vince. So in terms of timeline for this project, we see the first year being mainly devoted to establishing the strongest strategic alliance with Hainan Airlines. And then towards the back end of that process, we're going to be moving forward with this sub-branding effort and scaling that out to much of the existing Hainan fleet and then select aircraft of the Emirates fleet. And this project is then divided into 2 main expansion areas, our intra-Asia, which will be mainly fueled by a redeployment of rebranded Hainan aircraft, and then this Asia-Pacific, Trans-Pacific flight expansion, which will be fueled by the incoming orders of Boeing 777s and A380s that have longer range capabilities to really service that market. In terms of financials, we see some pretty robust numbers across the board, a 16.5% return on investment annually, 9% profit margins, which are up 0.5% from our company-wide annual profit margin last year, then a 3% compound annual growth rate on our return on investment, and then a conservatively estimated $9.8 billion incremental net present value. And a more aggressive estimate on that could see that up about 20% if possible. Now, moving into new international markets, it's very important to consider the risks. And some big ones that we see here are 1, cross-cultural acceptance, and 2, those socio-political considerations, namely that regulatory environment, which China's notorious for. But we see Emirates as being uniquely suited to mitigate these risks. First, through a high commitment to quality customer service and a very diverse workforce that will be embraced by all these new cultures that we're tapping into. And then finally, as we mentioned earlier, we'll be working with the Chinese government rather than against it by partnering with a majority-held Chinese government company. And so between those two, we feel that we've effectively mitigated these risks. And in terms of backup plans, we've explored options like M&A, entering other BRIC nations, but we're really confident in this jetting ahead strategy in China as a target. And what we feel MPV Consulting Group can bring to the table is deep industry knowledge and experience of targeting Chinese clients and forging those strategic alliances. This is what we do. So in conclusion, we feel that this plan, this strategic alliance, will take the best of what Emirates has been, combine it with the best that Emirates can be, and really drive lasting growth well into the future. Thank you, guys. And with that, we'd be happy to field any questions you might have.
I'd like to ask a question. I understand why you'd like to partner with Hainan. Why would they want to partner with you? The Chinese government doesn't need, you have a reputation, And certainly you have a reputation for quality, but that's something they can't buy when you have the unlimited wealth that the Chinese government has access to. What is it about you that's going to make them do the deal?
So it really boils down to these two trends we've been talking about and this demand for international prestige. China has money, but they don't have those country of origin effects and that international prestige. Emirates brings brand name to the table, they bring that foreignness, and we think that's a value proposition that we can bring that no other airline will be able to.
As a follow-up question to that, in terms of branding, by partnering with Hainan, it seems that it would be diluting the Emirates brand itself. Right now, Emirates has really developed its own brand as a very premier type of airline. Do you think by partnering with Hainan that would be diluted at all?
We really tried to, when we were selecting which Chinese airline to partner with, we really tried to use the airline that is already known for its luxury quality. And many would consider Hainan Airlines as being the Emirates of China. And so we really see that we can have an alignment of core values. And additionally, because this is a Hainan Emirates sub-branding, we believe this will not affect Emirates at a global stage in terms of its branding. It will really be targeted to this intra-Asia and Asia-Pacific market, which currently Emirates has not had much penetration inside of.
With the, kind of staying on that theme a bit, with kind of the general slowdown of the economy in China, talk to us about the risk factor of putting really all of our focus in one particular country, and what have you looked at for what if there's a significant slowdown in the economy, what's going to happen?
So we really sort of have two things going for us here. But first off, much of this Chinese economic slowdown has been contained to tier 3 and tier 2 cities, and these specific cities that we're in haven't received as much of a slowdown. But if things really do take a downturn and we realize that we need to pivot and exit, we feel that we're still in a position to do that. We've had limited to no investment and sunk cost in this deal as we're using Hainan specific routes and logistics. We're really just bringing our brand to the table. So if we need to pivot and move towards Hong Kong, Taiwan, Japan, a different eastern seaboard China country, we've already begun to build brand reputation in that space without a high sunk cost.
So, again, on this partnership, which I think we all find very intriguing, there seems to be a lot of overlap. And are you proposing that the Hainan flights that exist today to Seattle, San Francisco, and LAX remain in place, and then additional flights get added in the Hainan Emirates? And then also, what is the impact you see for Emirates in terms of the rest of the cities that they do serve in the Asia-Pac region that Hainan also goes to?
So that's an excellent question, and we really identified that because we have these two distinct market segments, the intra-Asia and the Asia-Pacific market that we are trying to move into, we see that Hainan, because it is primarily focused on domestic flights, it does do international flights as you mentioned, but its aircraft, its fleet is primarily suited for shorter distance. So with the intra-Asia market, we see Hainan's aircraft as being those aircraft to use. Now, for the longer distance flights, we suggest and recommend that because Emirates has one of the most modernized and luxurious long distance travel aircrafts available, we think these are the crafts that should be used for these long distance flights that we propose to the West Coast.
So you are replacing the Hainan flights at that point?
Yes,
That's correct.
generally.
Oh, and along your point of how this will affect Emirates' existing flights, we think that because we will have essentially these mini hubs that we can implement into the system, the mega hub will have a reduced congestion, and so this will actually increase the efficiency of all the different flights that Emirates provides currently.
You talked about 5 of the 6 are tier 2 cities. Obviously have infrastructure within the cities, but getting to those cities is a non-trivial challenge in various parts of China. Where are you going to get your customers from if they're not from those specific hubs? for those specific cities?
So China actually recognizes that it has a huge problem. China actually has a lot of congestion in this area, but China is building more, making a lot of efforts in terms of opening up airspace, and in terms of people getting there. They're actually building a lot of trains to connect all these cities together, so it makes it easier, even though perhaps they're not from the Tier 2 cities specifically, but the Chinese government themselves are already making it easier for all this to happen.
It seems that there's a very heavy reliance on both the Chinese market as well as on Hainan Airlines itself on this growth strategy. Is there any implementation or the use of Emirates capital expenditures themselves in terms of expanding the number of airlines that serve these markets through Emirates? Will you be operating parallel routes with Hainan Emirates, or will you be strictly using Hainan's airlines? How are you going to finance any further capital expenditures and the growth that you anticipate?
So in terms of routes so Emirates doesn't have many routes out of China right now. Mainly it's Beijing and Shanghai. So in that situation, we would replace it with Hainan Emirates because we want to build our brand proposition in that space. As far as within China, Emirates doesn't actually service a lot of that yet. And the service is primarily catered to bringing the Chinese customers from China into, in our expansion plan, the Asia Pacific, rather than actually cannibalizing on the customers who go from Dubai to these countries. So we will be targeting a different customer base.
And in terms of this capital investment that you're asking about, our biggest investment that we're bringing to the table is our brand name. Most of the logistic base, as we mentioned, is going to be brought by Hainan. There might be minor capital investment in terms of this rebranding effort that we will be working towards China with, but we don't think that the costs of that are going to be well exceeded by the returns on this project. So we feel that the major investment is really already made through the 6 hub location and logistics of Hainan.
So to be clear that I understand, are you talking about replacing Hainan completely within all of China with Hainan Emirates, or just these targeted routes?
It's going to be primarily primarily replacing these targeted routes, and as Vince was talking about earlier during the intra-Asia expansion, really moving this value proposition into that intra-China for like Indonesia, Vietnam to China, catering specifically to the markets that have higher growth rates and growing higher upper middle class. So it's not complete, it's targeted towards those higher wealth sectors.
You projected a 16.5 ROI. How will that be shared among the two partners?
So our initial take on the sharing the leadership structure will be a 30-70 for intra-Asia, 70-30 for trans-Pacific. We're using most of that existing Hainan base for intra-Asia, so we see them as maintaining the controlling interest there. But as we see our longer range high-tech aircraft being deployed along that trans-Pacific flight, we would maintain majority share on that.
On your financials, how did you factor in if Hainan, how long is that partnership going to take to form, and what if it fails? What's your next step?
So our financials factor in about like this 8th month to 1 year partnership formation period. In terms of contingency plans, we do not have direct financials on that, but as I mentioned earlier, we feel that most of our investment is brought by our brand. So that brings us flexibility in terms of pivoting towards more liberal airspace along that East Coast, whether Hong Kong, Taiwan, Japan. So we feel even if the situation turns south, we still have great opportunity to carve out that trans-Pacific market space.
How long would it take you to do the pivot, and which city would you suggest as the next option?
So the city we'd probably suggest first would be Tokyo and then Hong Kong. In terms of what this pivot would entail, it would be a redeployment of these aircraft and then minor agreements and infrastructural upgrades to gain access to these cities. Estimated maybe a 6 to 8 month timeline.
Would have you looked into the international tax implication of combining these two countries?
That is an issue that I would say has really been we've been basing it on the precedents, I guess, in some ways, of the alliances that have been created existingly. The term of partnership in the airline industry is okay.